Welcome back to Real Estate Mindset and happy Wednesday morning to y'all. I wanted to do a quick live video on a new article that came out from Market Watch, basically on the $1.8 trillion in debt that's due in commercial real estate. So I'm going to quickly go into that for you guys today. So it's not going to be very long, like I said, this live today, but very, very interesting stuff, you guys, because this is basically Goldman Sachs essentially hypothesizing how there's going to be more unemployment. And one thing that we, unfortunately, and this is not a good thing, but one thing that we need in the housing market to properly reset, we need forced selling. If forced selling happens, the housing market prices, the values of houses will continue to go down. We'll get more inventory and things like that. But it's really important to understand all of the black swans. There are many black swans: long-term rental market, short-term rental market, credit card debt exploding, defaults in credit card debt exploding, school loans. I mean, there are so many things going on right now. One important thing to pay attention to is what's going on in commercial real estate, not necessarily with vacancies and values, okay? But what's going on with the forced refinancing. And the crazy thing about this, guys, and this is probably why so many people are worried about unemployment spiraling out of control. The problem with the commercial real estate refinancing bubble right now is it extends like deep into 2026. So the odds are, especially if there's credit tightening like we're seeing right now and rates stay fairly elevated, the unemployment wave may last for several years. And we're kind of, it's been a little bit difficult to see these things. Obviously, the data is tainted. Obviously, we're kind of in the fourth inning. But as more and more of this dust settles, more and more of these black swans really start to show their head. And what this means to the little guys, okay? We're the little guys. And I'm going to tell you guys point blank right now, whatever happens, okay? No matter what happens, house crash, not house crash, we need to empower ourselves, because if we don't, someone else is going to buy our houses from us. The way we empower ourselves, a lot of times, you guys, we have to evolve. We have to get in ahead of the sheep. We have to get ahead of the flock. So this information is basically to help you do that, at least to be aware of the possibility and challenges to come, but also to let you guys know this: things change, okay? They always change and things get better. I want you guys to remember that we are in a rare time when basically we have an inflationary crisis. I mean, literally almost all grown adults, that are millennials anyways, have never gone through anything like this before. And a lot of people can't see the end in sight. And I'm telling you guys, it's a huge problem. They want us to give up. The more that we're aware and remain hopeful, the better off we are as far as being a winner on the other side of this. But let me go into this article, you guys. I have to hurry because I have to get out to work and I don't have much time. But the name of this article is: a $1.8 trillion wall of corporate debt is coming due, could cost jobs, Goldman Sachs warns. And what's really interesting is look at how they make cuts to their labor. Okay, I'm going to read this for you guys right here. For each additional $1, okay, in interest expense, okay? So for each $1 of interest expense, firms cut capital expenditures by 10 cents, or rather 10%, and labor costs, you guys, by 20 cents. So in other words, they're basically going to, for every dollar increase, 20% of the labor staff is going to get cut. Do y'all hear what I'm saying? So the fact that all of this debt is about to blow up and forcing these companies to refinance is going to mean there's going to be layoffs right around the corner. And the layoffs is a thing that's really, really missing here. And when I mean layoffs, I'm also saying a recession, right? But let's read a little bit of this. How you guys doing? I see you guys. Good morning to everyone. I see you, Orlando. I'm really trying to get through this fast, you guys, so you guys can come back here and take a look at this. But big corporations, okay? Big corporations aren't likely to avoid the bite of higher interest rates forever. They're okay right now, right? They're okay right now because they still have all of that COVID money, the PPP, the EIDL. Remember all the fraud? They still have that money, but it's not going to last forever. Now, particularly when an estimated $1.8 trillion wall of U.S. corporate debt coming due in the next 2 years, according to Goldman Sachs. Orlando is in commercial real estate. How you doing, brother? And he can confirm pretty much everything we're talking about. He is basically on the front lines of the commercial residential real estate meltdown and financing meltdown right now. Now, that also means companies could start cutting jobs and rolling out other belt tightening measures. Okay. So this is kind of happening pretty fast. Corporations needing to refinance existing maturing debt at today's higher rates will face higher debt costs. Goldman's economic teams expect a 2% increase in interest expenses for corporations in 2024. And listen to this, this is my point here. It gets actually way worse. This is a crazy thing. It gets way worse in 2025. Basically, they're saying in 2025, it's going to be a jump of 5.5%. So 2024, 2%, 2025, 5.5%. That is huge, you guys. So if we do go into a deep recession, we're gonna see some fireworks. There's no doubt about that. But if we have a shallow recession, right, or if we avoid a recession, by printing money and continuing to prop up the housing market and other assets, then maybe they'll be fine. Okay. They also found that a bigger burden in terms of interest payments typically translates to cuts in labor costs, okay, and capital expenditures based on an analysis of data from public companies since 1965. So again, we already have the historical precedents. When the interest, debt, and expense goes up, companies lay off their staff. Okay, we know that they lay off their staff, and that's what's basically right around the corner and happening like right now. And Orlando, maybe you can tell us, I think that's really going to start this month. Can you tell us, Orlando, as far as I don't know if you know that or not, but if you can't, comment below. I'll throw your comment up here. We find that for each additional dollar of interest, firms lower their capital expenditures by 10 cents, labor costs by 20 cents. We already read that. With that backdrop, they see potential 5,000 jobs drag on monthly payrolls growth in 2024 and a 10,000 drag in 2025. So it gets worse in 2025. So according to what I'm reading here, if we look at it just from a commercial, standpoint, commercial financing standpoint, the unemployment is going to be worse in 2025. That's interesting to think about. And it's going to get bad in 2024. That's interesting to think about, but look at this chart, you guys, and this is really going to show us how much corporate debt is actually maturing. You guys can see here's the remainder of 2023. A lot of people have been freaked out about 2023, but when we look at 2024 and 2025 and even 2026, it's like, my gosh, look at how much debt is coming due this year. Okay, the remainder of this year is all the way here. This is an annualized amount, but we have roughly $200 billion more of corporate debt, or it says up here $230 billion more in corporate debt maturities remaining in 2023. And we have $790 billion right here. $790 billion needs to be refinanced out of the low interest rates that they have into high interest rates. And in 2025, 1 trillion, y'all, 1 trillion in 2025. This is going to potentially be extremely bad. Not 100% sure, exactly how everything's going to crumble, but this is crazy, you guys. And I'm about to show you the 10-year. We'll look at interest. I'm going to, quickly wrap this up. Like homeowners, the article goes on, like homeowners, many big U.S. businesses were part of the pandemic borrowing blitz that helped lock in low fixed rates while also providing shelter from the Federal Reserve's rate hiking campaign in the past 16 months. But since companies typically stagger their debt maturities for the cheapest possible overall borrowing costs, it also means a growing amount comes due through 2026. So commercial financing, okay, the banking sector as far as commercial is going to be under turmoil and headwinds for at least 2026. Until the commercial financing sector can get through this surge of forced refinancing, there's going to be hard times ahead. I'm going to tell you guys that right now. And we're probably going to see a whole bunch of merges, a continuation of bank runs and things of that nature. We haven't seen that yet because, again, there's just so much money. They're burning the money. I'm really interested to see, next month's M2 money supply. That's another subject for another day. But anyways, moving on, you guys, as part of the problem has been surprisingly resilient. Again, this is saying a part of the problem has been a surprisingly resilient labor market, keeping inflation elevated and the economy humming, despite fears that the Fed's rapid pace of rate hikes would trigger a recession. Now, is the labor market really that hot? You guys probably saw the video I did with Jack yesterday about the labor market and the fact, if we look at month over month, okay, just from June to July, we lost over 500,000 full-time jobs in 1 month. Annualize that. When we annualize that, that's 6 million full-time jobs. So why does the labor market look hot, right? How are they adding all these jobs? It's part-time. We literally have the proof now. It is not full-time, healthy, strong jobs we're seeing. We're seeing part-time jobs. Why are we seeing part-time jobs? Probably because these corporations understand that there's a recession incoming and they're making a lot less money and they're expecting additional expenses to come. Probably. Now here, this article goes on about the labor market. A fresh labor market data points to the economy adding 187,000 jobs in July, a sign that hiring may be slowing. But with wages steady at a 4.4% annual rate and unemployment retreating to 3.5% from 3.6%, federal officials want to see yearly wage gains of 3% or less. So what this is saying is basically people are starting to get raises. Okay, basically, you guys understand. So people are starting to get raises, but the problem is, like we saw who just got a raise right now. I think was it UPS or someone just got a raise right now. It was like $167,000 salary a year or something. But the thing is the more and more people get raises just to be able to afford to live, right? We have to be able to afford to live, so we need to make more money. The Federal Reserve is destroying that. They're cracking down on the labor market. They're telling us, hey, first of all, if you want to buy a home, wait for a reset. So they're telling us to wait for a reset, but they're also saying, hey, we got to be careful with wage growth because right now, according to the article we just read, their target is 3%, wage growth at 4.4%. That means they're going to continue to hurt us. And the more and more they hurt us, the more and more likely it is that when things do break, things will get out of control. And if things get out of control as far as unemployment, I'm specifically talking about unemployment, and then I'll add on top of that credit tightening. When you have unemployment and credit tightening at the same time, it is a horrible, horrible nightmare. That's how wealth gap exists, and that's exactly what happened to me in 2009. I lost pretty much my job, all of my income, cash flow, and my credit was destroyed. So I had no income, and I had no ability to get credit. So in other words, you guys just be very cautious going out there thinking right now is the best time to buy. I've been seeing YouTube videos that if you didn't buy last year, you lost all this money and all this crazy stuff. But the reality is right now, you guys, interest rates, it is a mathematical certainty that interest rates will go down. And more than likely, from a fundamental historical precedent, values of homes will also go down. All right. Now, I just wanted to show you real quick. Let's take a look at the 10-year and I'll get you guys out of here. I definitely appreciate your time. Here's the 10-year. It is still in the 4%. What a drastic change in the 10-year. Look at interest rates. Let's see if we get mortgage rates. Here's what mortgage rates are sitting at right now, according to Google, almost 8%. That is insane to me, y'all. That is insane to me. Let's look at a payment calculator. I want to show you guys basically, what it would look like for a corporation basically going from a 5% to a 7.5%. I'm going to use a 300,000. That's going to represent 300 billion. So basically, if you guys look, we'll look at this from a homeowner standpoint, and we'll just add 6 zeros. Okay. But right now, basically, corporations, hypothetically, if they have a $300,000 loan, 5% interest rate, or if it's a mortgage holder, your payment's only $1,610. Okay. But when you refinance, or if you purchase a house right now, your payment will go from $1,610 to $2,097. Okay, so was it $1,610 minus $2,097? This is hypothetical, of course. $487 difference a month, which if we add 6 zeros. So watch, 487, let's add 6 zeros, 1, 2, 3, 1, 2, 3. That's a potential additional interest expense of $487 million. So according to the article, again, 10% deduction on expenditures, 20% deduction on labor costs. You guys do the math. Just wanted to report this. This is an updated article. It just came out. Hope you guys have a tremendous day. That's all I'm going to give you guys today. I hope you liked my video yesterday. I'm going to put out a really important video tonight. I hope you guys make it. And also let me know if you guys want me to do live on locations. Here's what I'm planning to do, you guys, just real quick. I figured out how to turn my GoPro into a live camera. So I'm thinking about taking you guys live to new build communities and basically walking new build communities when all of the construction is going on while I'm live. So I don't know if you guys want me to do that. I think it would be cool. It's going to be a huge pain in my neck to do that. So I really need to know you guys want me to do that. Comment below. Sir, I see you, Josh. I see you talking, Jeff. Do y'all want me to go outside? Do y'all want me to bring you on location live? Let me know. On location live. That's what I'm planning on doing. I am hacking the GoPro. Appreciate you guys so much. You guys have a great day. Remember, be proud of yourselves. Empower yourselves through your discipline. And as always, you guys use the data to find the deal. And if you're out there investing in real estate, I see you guys. You say go outside. I appreciate you guys. All right, I'm going to do a live on location. That's going to be one of my next videos. But if you're out there investing in real estate, you know I wish you luck, and I hope you win.